near a 12% stake in Santos. Let's get some analysis on this with Julia Lee from Bell Direct. Julia, welcome to the program. Good to have you with us. So we've got this Chinese company buying an 11.7, to be exact, stake in Santos. Is there any talk out there that this could be, the first step towards some sort of a full takeover?
It is a significant stake, so 11.7% by ENN, and if we have a look at this Chinese company, it's a private gas distributor in China, and it is looking to move into a vertically integrated company. So this is the first move that it has moved into upstream assets, which is quite interesting, but also this is a company that was interested in taking a 15% strategic stake in Santos last year, and of course Santos ended up going with Hony in private equity, and Hony's really just flipped this stake into ENN and taken a stake in ENN instead. So it is quite convoluted at the moment. There is a lot of speculation that this could be the precursor to a takeover, and that's why Santos is trading high today. You're starting to see that takeover premium being built in, but right now we just don't have enough information, and the poor CEO, Kevin Gallagher, he's only been in the job for 7 weeks, so no doubt he'll be trying to figure out the intentions of ENN with that strategic stake. 11.7% is quite significant. But at the moment it looks like market betting that this could be a precursor to a takeover down the track.
Wouldn't there be some big concerns if there was a Chinese company looking to take full control over an energy asset here in Australia?
It would have to go through the Foreign Investment Review Board, but given the number of gas projects coming, I guess it's a little bit confounding why they chose Santos though, because if we have a look at Santos, the offtake is mostly contracted out. So if they are looking to get their hands on gas and gas supply, Santos probably wouldn't be the first choice for a company like ENN. But of course, the Chinese do seem to be hunting in Australia for assets, whether it's in the healthcare space or whether it's in the energy space. So no doubt that we'll be seeing more of this, and more by some of the international companies as well, with that weaker Australian dollar making Australian assets relatively attractive. So we're still yet to find out the intentions of ENN. It is a little bit of a strange one, given that most of the gas that Santos is going to get out of the ground is already contracted out. But ENN has said that it does have ambitions to be vertically integrated. It's a first move into upstream assets. We will probably see Kevin Gallagher going over to China to figure out the intentions there and get a little bit more information, but certainly it has boosted not only Santos but also I think the whole sector, because oil prices were down 4% overnight, and you'd expect the sector to be under a fair bit of pressure today, but you're seeing the energy space only down by 0.2%.
Yeah, it is really interesting. It's also interesting that Santos has said in a statement to Reuters via email that it will be keen to meet with ENN and discuss whether there are opportunities to supply gas into the Chinese gas market. So I guess, silver lining that could potentially open up a big market to Santos as well. We'll leave that there for now. I'm keen to get your take on ANZ and the share price movements today. It has been a swift and quite a violent reaction to this additional $100 million write-down or potential write-down in the first half, coming on the back of bad and doubtful debts from ANZ. Did it surprise you at all, the extent of the market reaction to this, considering we are in confession season for 3 of the big 4?
I don't think so. I think that the banks have had a good run up the last few weeks, so we're probably seeing some profit taking on the news, and the fact that it's probably not going to be just ANZ which is seeing an increase in this bad debt cycle, but some of the other banks as well. In fact, we've probably seen a low there in the bad debt cycle, and we've been talking about that for a while now. So we've seen ANZ increase its bad debt provisioning by $100 million to $900 million, and that comes on top of the announcement last month where we saw ANZ coming out to say that bad debts were rising in Asia. Now they've come out to say that bad debts are rising because of exposure to commodity-based companies. Not only that, we've seen Westpac coming out to say that they're probably going to raise their bad debt provisioning related to their top 5 corporate clients as well. So I think we're going to see more of this coming out of the big 4 banks, but the fact that we have seen such a strong run up by the big 4 banks this month probably means that we're seeing some profit taking on the back of this announcement, but also in terms of the big 4 banks, conditions are tough. We know that it's tough. One, in terms of margins, we're probably seeing margins being squeezed, and this is a trend that's likely to continue over the next few years. Secondly, the bad debt cycle looks like it's ticked upwards, so this is going to go upwards. And thirdly, the capital requirements in this area are simply increasing. So a difficult environment for the big four banks. I guess the market focusing in on the negatives. On the flip side though, the banks have a good track record of trying to control some of these constraints that they're dealt with. And earlier on in the year, we saw banks like CBA raising the interest rate on mortgages and that was an out of rate hike. So there are ways for banks to recoup, I guess, some of the challenges that are out there in the marketplace, but for the time being, the market concentrating on the negatives and probably taking some profits given the big run-up that we've seen in the big four banks over the last 3 or 4 weeks.
Yeah, and considering the losses in the banks, we couldn't have expected much from this local market today. Not only that, but we've got the shortened trading week with Good Friday tomorrow. So, we're at the 3-week lows, or right around there for the Australian market today. There's not a whole lot of news to digest, I guess, over the Easter weekend, except we are waiting for that GDP read coming from the States. So, yeah, how do we sort of position as we head into this long weekend?
Look, and I think that's a key driver for the Australian market at the moment, what's happening in terms of the US. And really overnight, it was the hawkish tones by the Federal Reserve members, which impacted on asset markets. And that's what we're seeing playing out here in Australia. Now, that impacted on currency, which has a big impact on the Aussie share market. So the fact that we've seen the Aussie currency come down means that our markets is less attractive for international investors. And if you expect the Aussie currency to weaken further, you're probably seeing some profit taking on some of those strong gains that you have seen over the last 3 weeks in some sectors like the banks. So the prospect of higher US interest rates, obviously not a good thing for risk assets, and a stronger US currency. Well, the usual suspects are doing well today. Amcor, Aura, Brambles, as well as CSL and Ramsay. All these stocks are gaining on the back of that stronger US currency and the weaker Aussie dollar. Commodity prices lower, so the materials down by around about 2%. The defensive areas are outperforming, so healthcare and utilities are doing well. And interestingly, in China, we've just seen a Reuters report out that China has lifted the short selling ban, and 35 domestic brokerages have now been authorised to permit short selling. But we aren't seeing a big impact in terms of the Shanghai Composite, which is only down by 0.9%. So I think that's a positive there, that we've seen some sort of stabilisation in terms of the Chinese market, and that news like this can come out and we don't see a massively volatile day.
Okay, Julia Lee, always a pleasure to chat. Thanks so much.
Thanks, Nadine.
Julia Lee from Bell Direct.